So if Ferroli is right at JP Morgan and the max is half a point, would sort of offset the benefit we thought we were going to get from USMCA and Phase 1, right?
Well, I do think you're going to see some of this U.S. exceptionalism fading. And we have U.S. growth next year at 1.7% compared to 2.3% this year. So that fiscal support is coming off. And, the question we have is there, really better value in some of the international markets as we look into 2020?
You did say you advise favoring EM, Europe, yes, and Japan?
Yeah, over the United States. I mean, we're still pretty constructive on U.S. equities. We're at 3,400 at the end of the year, but emerging markets was really the laggard this year. And with more stability in China, we think the valuations are more attractive, and we're still watching some of these technical factors in the market as well.
Brian, from your view, how are we set up here? Obviously, it's going to be a great calendar year in terms of returns on a flat earnings base, coming after a pretty poor year on a very strong earnings gain in 2018. So going into next year, it's been common to say, well, earnings should pick up single digits. Maybe the market does the same. We didn't get that kind of synchronicity the past couple of years.
Yeah, I know. It's one of those things where you're just thinking, what is going on, especially given the fact that you really want to be a fundamental investor. And per your point, earnings were great last year. But why were they great? Because of the tax cuts and people bought back stock, right? Now, this year was a confluence of events. We'd write about it in our year ahead piece where we talk about there's so much analysis paralysis. And that's really what caught investors behind the eight ball this year with respect to trying to time the market based on some macro factors like being too negative on the market based on the yield curve, and they missed the forest through the trees. So I don't think it's going forward, I don't think it's so much a point of American excellence. I think it's about American stability on a fundamental perspective. If you take a look at the standard deviation of earnings growth, it's exceedingly stable relative to the rest of the world. And I know Joyce's call, and I respect the call, and I think it's a great call. But it was the same call last year, right? And if you were overweighting emerging markets, you dramatically underperformed this year in a global portfolio. And I think one of the things people want to think about, Mike, and you're probably going to start talking about this, is when the calendar turns January 1, the quant funds and global funds are going to force your portfolio to buy U.S. stocks because they are underweight. And so I think you're going to have another liftoff to begin the year.
You have the European, broad European stock index just clicked to a 20-year high, meaning it just eclipsed the high from 20 years ago. Joyce, I mean, do you think that's telling you the rest of the world is actually picking up, or is this just kind of a global liquidity push?
Well, I think the fourth quarter is actually the worst quarter for manufacturing, so you should see a bit of an uplift, but I think it's a really modest uplift here. I actually agree on the 3,400 base case, for the U.S., but I think that outside of the U.S., you have better value. One thing we're actually more concerned about is that some of these systematic strategies are building up again. We're probably at the 75th percentile right now on U.S. equities. So we do see...
In terms of their exposure?
Yeah, in terms of the exposure. Fundamental investors we think are average, but we think the systematic strategies actually are building up again. So we're a little bit more cautious on the U.S. here given the valuations, although we do have a very constructive base case ahead for it. But emerging markets was the real laggard. Even with more clarity in the U.K., we don't see that as an opportunity, except for a few domestic sectors, not for the FTSE 100.
You mentioned technical factors a moment ago. What do you mean?
So the technical factors, there's a systematic trading. I think on the repo funding, there's a much more proactive approach by the Fed. $250 billion injected, $640 billion in total when you look into year end. But it would not shock me if you have some of these spikes on the last trading day. Again, and on the systematic strategies,
in the repo rate?
Yeah, in the rate and on the systematic strategy that you get these sort of like little mini shocks that we've seen. I think that's become part of what is now normal in the markets.
You agree? I mean, Powell addressed this at length last week.
It could be, but I think the bigger picture is what's going to be the longer-term rate with respect to how we're looking in terms of risk-free rates and risk premiums and what the 10-year is going to do next year. It's pretty clear that the Fed's not going to do anything next year until after the election. I think there's been a little bit too much near-term focus on the repo rate. It's actually settled down quite a bit. I think it's very difficult to make a call that something's going to happen the last few days of the year with this, especially given the fact that it's been a tough year on Wall Street in 2019. I think a lot of people are going to be on vacation the last week of the year, quite frankly. And I think the real trend of the market's going to start kicking in the first couple weeks of 2020.
When you say that the 10-year yield, I assume you mean it's really not going anywhere? Because
I think the Fed funds rate is not going to go anywhere, Mike. I think that the 10-year yields could creep higher, and you're going to see a steeper yield curve, which benefits our bullish case on financials, especially money center banks, which, you talked about some of the banks hitting 2007 highs. That's principally because it's been a chase trade, right? You've been talking about it the last couple of days on how investors have been so underexposed to financials, and that kind of posts to the value trade. Now, we think value and cyclicals, you want to know what you're getting into, and that's why the value trade here in the United States still has a long ways to go. I'd much rather buy value in the United States than try to apply value in emerging markets or Europe.
Finally, Kaplan's on the tape this morning. He says you can run a tighter labor force without risking inflation. Seems to be consensus on the committee. Do you think there could be a surprise on that in 2020?
I think the inflation and the growth expectations are actually pretty muted right now. If there's any surprise, it's one more ease. That's not out of the question in the second quarter of the year. We have to see what the Fed review brings, but we are wondering whether they're going to move to a more flexible inflation targeting where they actually try to overshoot. But I do think the first quarter of the year, as Mike Ferroli has pointed out, is the weakest quarter. I do see value as well in looking at energy, materials, the industrial. Very similar to Brian, but we are seeing growth still coming off in the U.S., and we are at record highs.